Hey, friends. Today we have a special guest here with us. We have Rakhee. She is a mortgage specialist. She knows all about mortgages, and we're going to pick her brain. Rakhee, why don't you give us a quick intro on yourself before we dive into all the stuff we're going to talk about today?
Absolutely. Thank you, Amir, for having me. I am a mortgage broker, so I help individuals secure loans to purchase real estate property. What I also do is ensure that you secure the best rate and the right rate to fit your long term wealth building goals. And it's important to also ensure that we're supporting clients with understanding strategies in terms of building wealth in real estate.
Amazing. So now we know that there's a lot of people out there that have a lot of questions about mortgage stuff. And we also know that there's a lot of people that put, information out there that might not be 100% right because they might be part-time people or, they heard something here and there and their opinions might not be in the right spot. So what we like to do is we like to have guests like yourself here to talk about what really matters and sort of get into the nitty gritty. So I'm really excited to have you here. So first thing we'll get into the mortgage scoop, and
Mm.
let's talk about what you see and from your perspective in terms of what's happening right now versus what's happened in the past. And we can look at the last time we've had sort of an up and down in rates like this, and how does it compare?
Absolutely. Right now, we've seen such volatility in rates. Right over the last couple of years, we saw a significantly higher rate environment, and there was such a significant impact on households that we're used to seeing rates within that sort of, we had rates as low as 0.99 in 2021. And we all went into what's referred to as a little bit of rate shock in 2022 and for a good part of 2023. What we've now seen is rates have started to come down, and that's been a little bit of a relief for a number of households. The anticipation is we're going to continue to see rates come down. And for the first time in a few years, we're seeing the variable rate product be a strong contender when clients are looking to secure a mortgage.
Very cool. And so looking back, let's say, when was the last time something like this happened where we had such a big up in the rates and then, a dive again? Can you think of a time? I don't know if I was
So
around. I don't know if I was old enough to buy a
think
house then.
we were very young. So, this is definitely a time in the 80s where, we've made reference to conversations, with parents and family at the dinner table
Right.
where we were in a very different rate environment. Historically, what goes up must come down. And I think that what is important, and this is what I often really stress for clients, is that we date the rate and marry the strategy, not marry the house, but marry the strategy, right? Really
Right.
long term. The rate when we're securing a mortgage in Canada, it's for 2, 3, 4, 5 years. 5 years is sort of that typical term that historically Canadians have secured when they're looking to secure a mortgage. So it's a short-term strategy, and when played correctly, we can make it work to your advantage based on current market conditions. So right now, rates are on the decline. So we'd be very hesitant to lock in a client on a 5-year product. We would be more sensitive to ensuring that we're giving a client flexibility on a shorter term or looking at the variable as a strong contender, giving flexibility. I think what we've realized over the last few years is that life is unpredictable and we need to pivot and adapt to market changes.
Right. Now, I know we can't predict a whole lot. However, looking
Mhm.
historically, I'd say it's safe to say that mortgage rates have been more down than up, especially compared to what we've seen in the last little while. So the time that they were down has been a lot longer than they were up. That would you say
Correct.
that's right?
Correct. And I think we got very comfortable with that lower rate environment. But if you actually look at rates, we're sitting very close to where we were sitting in 2018. So rates are at current in line or at par with what we were seeing in 2018. But we got accustomed to that very low rate environment, which in reality isn't necessarily sustainable.
Right. And so, depending on anything that's happening, you can't really predict exactly what's going to happen. What would you say to people that say, "Hey, I'm always going to get a variable because, historically they're always been down."
Well, they've outperformed, right, the fixed rate mortgage anywhere between 0.75 and 1%. So the variable rate product has always sort of outperformed. But that's where you also need to take a long term focus. For a few years there, we had variable rate holders panicked, overwhelmed, upset at their mortgage provider for swaying them or allowing them to select such a product. But now, as we start to see rates come down and we see that spread or that difference between the variable and the fixed narrow, they're
Right.
now in a position to sort of ride the benefits. In the current rate environment, we've seen actually fixed rates go up slightly. The bond
That's
yields
right.
have been trending higher, but the variable rate has continued to come down. So there's always that balancing act, and it's important that you're selecting a product that meets sort of your financial constraints. Not everybody can weather a variable. And that's a
Right.
very real conversation to be had. What works for me may not work for you, and it's finding the right product. But in this environment, if you're taking on a larger loan exposure and we anticipate rates to continue to come down with the next Bank of Canada announcement on December 11th, the variable may be the way to go if you want to ride the rates down.
And I think this is a perfect time to be talking about this right now because we just had a big reduction,
We
huge
did.
reduction, right? Which was sort of a surprise to a lot of people at 50 basis points. It's huge. And then we're likely going to have another one. We'll get some predictions down the road, but I think it's a perfect time to be talking about this to kind of put in perspective for folks where we're sort of headed. And I think that a lot of people expected as the rates started to come down, we would just see that froth in the real estate market just start to build up really fast again. And we're seeing some stuff at this end, but we're seeing a lot of people more sensible, more cautious than they were before, and not sort of running crazy after houses, thinking that they're all going to be sold out tomorrow.
I don't think we're going to see a repeat of 2021. I think that the last couple of years have been sort of a lesson to ensure that you have a strong handle on your finances. And although rates have come down, I think one, we need to give everybody a little bit of period of just sort of catching their breath. We're also seeing a number of changes to lending guidelines that will be coming out later this month and into December, which gives a number of potential buyers new opportunities. So I think a lot of people are seeing this as an opportunity to gather information, but I definitely will be agree with you. I don't think we're seeing that mad rush and those multiple bids or those extremely busy open houses. What I think we are seeing is a slow but steady build up in momentum and buyer movement.
Right. I think that time was more of a perfect storm for everybody.
Yes.
And for some reason, it was hard education for a lot of people too that, were told by somebody in their sphere that, hey, if you don't get in the housing market right this minute, or you don't become an investor right this minute, you're never going to buy a house again and you're going to miss the train. So I think we had just a ton of FOMO, perfect storm for that to happen. And I think we're still sort of seeing some of that stuff unwind with all the people that are sort of have purchased properties, especially from a builder, where the builder is still expecting that kind of money from them, but
For
the
sure.
market is saying that your house is worth maybe $150,000 less than what you bought it for.
And that is painful. And we're seeing quite a bit of that in the current market. We're seeing pre-constructions come up for closing where people are having to walk away from their deposits because they're unable to bridge the gap. Current market pricing has changed as a result of this change in interest rates. And although rates are coming down, it's going to be a while before the market adjusts. I think that what we're seeing in terms of market value is really reflective of true market value. And we need to we need to have real conversations. As rates come down, we're hoping that there isn't another mad rush. I think that it is healthy to have a steady and balanced market.
Right.
And right now, as rates come down, I think it offers an opportunity. When rates are at record lows, we see that mad rush, we see competition. So, are you really saving an interest if you're buying at a higher purchase price? There may be opportunity in the market today. So it's basing the conversation on what is doable in the market today, what's available to you based on what you can afford to buy. What would that mortgage payment be? And are you comfortable carrying it right now with the hopes that as rates come down, that may shift and change? But if we wait, rates come down, property prices may also increase because we've seen historically that that does increase competition, right? More people are out there trying to shop. Now, again, I think it'll be more of a balanced market. I don't think we'll see that rush that we saw a few
Right.
years.
Right now, I sort of see it as sort of a Goldilocks time where you can still go and save money off of a house and then potentially pay less for it down the road too, as the prices still go up. That's sort of the way I see it. And I see a couple different sectors that have sort of opportunities to get in and, let's say get a good deal versus what likely will happen in the next few years. What do you see? What kind of which sectors do you see doing better in this good time?
I think this is an excellent market for anyone that I call the sandwich generation, right? That are looking for more space, that, their lifestyle and their needs have changed. This is a great opportunity for you to maybe you're selling for a little less, but you're also buying for less. So
Right.
that gap is bridged. So it's shifting perspective as opposed to thinking, well, I might get less for this property that I'm selling now to upgrade, but the value is that higher priced property today, you may be able to secure it a much lower purchase price and waiting to secure more. So in the end, it's really the size of the mortgage and what your monthly payment is. So it's important to have those considerations now. So sandwich generation, great opportunity. There's
Yes.
also great opportunity for anybody that's looking to purchase a property that's an investor. The market offers opportunity right now for investors. Great opportunity. And
100%.
it's
I see
really
that
the
too.
education. And where they're considering higher rates, I mean, rates can be effectively used as a very smart tax strategy. So don't focus on rate, focus on net what you're going to have additionally in pocket, how much wealth you're going to build. So it's a shifted focus. Sometimes with an investment property, you may opt for a rate that's going to work for you in terms of offsetting some of your tax
Right.
exposure.
And a savvy investor usually knows that this is more of a long game than a short game. And you know
Absolutely.
that real estate sort of the time forgives things. However, this is sort of a time where even if you didn't do too well in the last couple months, you would still want to invest again to make up for maybe any of the losses that you had the last couple of years because we're likely going to see more of an up down the road than a down. But also, I've noticed some of our first time home buyers getting active again. We were able to sort of kind of put a pulse check on them, see how they're doing, we'll check in with them. But you see a lot of them back on the market looking at properties because now there's hope. And they're like, wow, we can have a lower rate and we can buy a house. So,
The
they can have both.
realization, absolutely. The realization is that that's not making any more land, right? So we know with confidence that home prices are going to continue to increase over time, taking a long-term focus. And getting into the market, speed of market is your opportunity to start building equity and wealth over time. So the longer you hold a property, the more you're going to reap the benefits. Obviously, speed of market has value. And I think in the market today, this is a great time for people to assess because people are more comfortable with knowing that rates are coming down. They're a little bit more sort of ease. There's a little bit of stability as well and opportunity. And I think this is a great time to consider those options. And I definitely see first time home buyers, knocking at the door to run those assessments because post December 15th, you can now enter the market with a minimal down payment and go up to a purchase of 1.5. You can extend your amortization to 30 years and you can buy that long-term property with what you have in savings today and you can minimize what you're going to be paying and that's comparable to what you might be paying in rent today.
Right. And rents, even though they've come down just a little bit in some
Yes.
parts, but not really. Me being a landlord myself, I've seen rents go up. I don't usually like to hike up my rents, but some people have had to because they have to have a mortgage they have to pay. They can't just, be a charity. So what happens is when these mortgages start to get a little bit easier, I think it's going to be a lot easier for landlords to be able to finance these homes a little bit better as well.
Absolutely.
Good. And so going back into the first time home buyers, going back
Mhm.
to that subject, have you noticed an uptick in a lot of first time home buyers coming in again?
Yes, absolutely. So we're definitely starting to see momentum for first-time home buyers in the market.
In terms of the government programs that have been implemented, has that been helpful?
They're to come, so we'll see. We'll start to see the impact, but I definitely think that it will be impactful. I find that a lot of the clients that we service at Mortgage Savvy are strong income earners, but usually the shortfall is the down payment piece. And
Right.
with current insured guidelines, you can only go up to a maximum purchase price below 1 million. So that's 9,999. And that's quite limited. There's not a lot of options available for young families to enter the market, purchase a property below $1 million. That's going to be a long term home.
You have to come to our area. We got lots. You got to come to Orangeville. Come to Orangeville, Fergus, tons of them available. So if you're looking for something like that, come over here.
For sure. And this is where it's important to also assess quality of life. I think that's the conversation that we're having, right? Just really understanding what your long term goals are, being flexible. We still have a lot of remote work, and there are opportunities outside the market as well to explore purchasing a property. And, at times, even looking at options on the go train, right? Just in terms of those that are having to transition back to part time sort of in person work, there is flexibility and there's opportunities outside the market. But again, with first time home buyers, it's about educating them on their options,
Right.
understanding that once these changes come in, even for that client looking to buy out in, for example, being able to go to a 30-year amortization makes it affordable, makes that payment affordable, and it's doable. Also, the down payment piece, it's hard. Standard of and cost of living has gone up, and it's difficult to put that sort of savings target away every month. Life is unpredictable. Again, you have an unexpected expense. So being able to get into the market with a minimal down payment and go to that extended amortization opens up opportunity for so many first time home buyers.
Now, I don't know if you have anything handy, but let's look at, say, a $500,000 mortgage, right? Would you say that's fair? Or is that really low?
So a 500,000 again, depending on where you're looking to buy. Now in the condo market, that's doable today, whereas a few years ago it may not have been. So again, that is sort of for quick math, a nice round number to be working with.
Let's clarify for our people that are a little bit further north and that are right in like Toronto area, north of Brampton. We'll call them Cal and Orangeville. How's that? Let's look at a nice family home that can go for about 800,000.
Okay.
We got a first time home buyer. They've scrounged up some money and they got $120,000 put together. Now, are they able to buy this house?
Depends on where their income is sitting, but yes, with the down payment, absolutely.
Okay. So let's say they put down the $120,000
Yes.
on this house, putting you on the spot.
Okay, let's see if I can do this.
What's the and I'm not asking for exact numbers. We'll obviously need to look at a lot of different factors like taxes and things like that. What would be their approximate mortgage payment monthly?
It depends on what we're securing in terms of rate. Your monthly payment. So if we're doing an $800,000 property with 120 down, your mortgage payment is going to be about on a 25-year amortization based on current market sort of conditions and lending guidelines about 3,700.
Oh,
But
wow. Okay.
post December 15th, that goes down to 3,400 a month.
Wow.
That's a significant change.
And so now that's your money that's going towards your house where you're going to be staying. So essentially your bank account that you're putting money into versus spending the same amount of money on a rent because that's how much the average rent is in that town.
Is it?
So
Okay.
that's right. It's expensive. So instead of having to do that, instead of having to rent and pay somebody else's mortgage, you can get yourself a house. And I mean, we sort of looked at very general numbers here. You thankfully were able to give us some quick numbers there. But I would
Absolutely.
say as time goes by, this is going to become sort of easier as well. And we may not have to look at a $800,000 house. We have condos that are cheaper too in the hundreds that can be financed. But I'd say this is the time for a lot of folks that have been sitting on the sidelines that think that maybe they couldn't get into the market to at least give it a try.
Absolutely. Crunch the numbers. Numbers don't lie, right?
Yeah.
Look at what you're spending today versus what you'd be spending if you moved into home ownership. And those that are struggling with the down payment, maybe you put a little less down.
Yeah.
And, as opposed to waiting, maybe we look to see how much you're entitled to for an RSP. And maybe we secure an RSP loan, which we can help with and
Yes.
support you in getting into that home in today's market that much faster. So we can bridge those gaps. We can get
Yeah.
creative. And it may not be today, but once we devise a strategy, makes it easier to hit those milestones and move in that direction.
Right. I find, these folks need a fair bit of encouragement because there's a certain amount of anxiety in disclosing all your information to somebody to say, hey, here's my stuff. Don't reject me. And so they're putting their hearts on their sleeves and going out. And I'd say, I would rather know. I'd rather know than not know. So I think it's a good idea to actually go and try to get this mortgage and try to see where you are. And what's the worst that happens? You actually know where you're going to get to or you want to get to. and you can strive for that.
So I think it's important to know that we're accessible not to just be transactional and give you a document that's a pre-approval. The
Right.
conversation is to ensure that we're eliminating any fear. We're giving you an education. We're helping you understand what is important, what is relevant, and it's about building a roadmap and providing you with that support. We're busy in our day to day, and if you're really good at what you're doing, you don't have the capacity to put the time, energy, and effort into understanding how to put a plan together. And that's where you're deferring to a specialist or someone that's there as a mortgage broker that can provide that coaching and support and hold you accountable to those targets, because we all need accountability. It's like going to the gym. I use that as an example. We'll invest in that. We need to have that same mentality when it comes to managing our money. We get busy in the day to day. Wouldn't it be great to have somebody that we're accountable to ensure that we're kind of getting to the places that sort of align with our long-term vision and goals? So it's not about immediate always,
Yeah.
but it's about understanding today where we are and where we want to reach and what those gaps are and devising a strategy to get there. We can get creative.
Yeah. It's like getting a coach at the gym, or you get a personal trainer at the gym, you get a personal trainer for your money. And, often our services are free. So
They are.
what do you have to lose?
For sure, for sure. And we've heard so many. I often say that it's the stories. We've heard the stories and we've devised solutions and we've been able to get clients there. So having the opportunity to have that conversation in a safe, sort of trusted environment where you can lean on somebody else for that support can make a massive difference in how quickly you're able to move from where you are today to where you want to be in the future.
Very good. Very good. Let's shift gears again to our other demographic, which was the investors. And I'll throw more examples at you if that's okay. So
Absolutely.
let's say we have an investor who has, say, 3 properties,
Hmm.
and two of them are more recent. One of them's getting one of the mortgages is maturing, and they have some equity built in that. And they also have their primary property, which they have a mortgage on as well. Now, I'm going to throw that scenario at you. Tell me what would be the best thing for this person to do.
So we're always going to be exploring tax strategies with a client in a scenario like that. There is cash damming. There is the ability, your only tax-free asset in Canada is your primary residence. So the ability to take equity at the time of renewal or offer a variable product with your investment properties, the ability to tap into that equity. So whether you're utilizing that for an investment that's going to yield a higher return than what you're paying in interest, or utilizing that equity to optimize on your prepayments on your owner occupied primary home, or using that towards purchasing the next investment, we're going to devise strategies. Doing that actually helps you net more in pocket. So it's devising smart tax strategies to help you get ahead. When we're looking to invest in investment properties, there's the appreciation as the property grows in value, but it's actually the access to equity that helps you get ahead. And it's that shift in mindset that changes the approach when we're looking at working with an investor client. But that's a client that's going to want to pull the equity and make it and put it to use.
Give me an example of cash damming. How would that work for this person?
So if a client wanted to take the additional equity that was built and apply it as a prepayment, for example, on their owner occupied home, they can then write off the interest component of that mortgage payment. And so it's now offsetting their overall sort of income tax exposure while working towards their end goal of paying off their primary. Let's admit we all go to work, we get busy, life gets in the way, there are expenses. It's hard to get ahead. And there's a sense of freedom that comes from being mortgage free on your primary. Now, I do believe in leverage, but I believe it's important to have a balanced balance sheet and ensure that we don't all have our eggs all in one basket.
That's
When
right.
I started Mortgage Savvy, my brokerage, it was based on the mandate to help clients be mortgage free. So I was a brokerage that was going to help clients be mortgage free. And how was I going to do that? It's like the 3 property model. One owner occupied, 2 investment properties that over time we utilize from a tax perspective to pay off a primary and then maybe make available further leverage for further investment strategies.
Very cool. Awesome. I'm sure there's going to be lots of investors going to have more questions about that.
Yes, and we construct strategies that are very specific to our investors' sort of overall portfolio. Where are they sitting? What are their financial covenants reflecting? And how do we help them get ahead?
And what would you rate the investor activity right now? Would you say it's gone up since last reduction, or is it sort of the same? What's happened for you?
So I do believe that savvy investors are seeing opportunity. We're definitely seeing an increase in the multi-unit sector. We now also have expanded to offer commercial services as well and CMHC products that offer clients the opportunity to purchase $5 properties with, the 5% down and that are cash flowing with positive rental income. So there is opportunity in the multi-unit. We're definitely seeing that very strongly with these new changes anticipated in January that would allow investor clients to go up to 90% if they're able to add a laneway house or a finished basement. I mean, there is opportunity. It's about understanding the education and understanding the options as they apply to you specifically.
Very good. Very good. So let's talk about other people that are, let's say, haven't felt this pain and they're starting to feel a little bit better, but they're in a fixed mortgage rate and they're coming off of that between the next few months, but they've always been in a fixed one. How would you advise somebody like that? And I mean, obviously it's going to hurt either way because they probably locked it in at a really good rate. But yeah, let's say they are looking to renew. What would you advise somebody like that?
So it's not as scary as they think. I find that a lot of what we're hearing in the media can be terrifying, but crunch your numbers. So I'm going to urge you to connect, crunch your numbers. We have solutions available to us. One, we no longer need to stress test on renewals. So the government's implemented some new rules on November 21st that remove the need for stress test on your renewal. So we can go to market, get you the lowest possible rate. So if you're worried that your income has changed and you're afraid of your ability to qualify on a renewal, don't auto renewal with a lender, your current lender, without doing your homework. A. Two, we can look at the ability to increase your amortization, keeping your payments very similar to where you are now. So there are options available to us to help construct a mortgage product that's going to be supportive of keeping your payments within your affordability. Now, as rates are coming down, it's important if you're going to offer a fixed, don't focus on the rate. Focus on also the ability to exit that mortgage term. If rates continue to come down in a year and a half, 2 years, you want to be able to pivot and get that lower rate to reset the amortization. So there are short-term solutions that we can put in place for long-term gain. So I often say to clients, let's take a longer term outlook. Let's keep you comfortable because we all need to ensure that we're operating within our financial parameters. If you can't afford it, you can't afford it. But then let's ensure that we're building in some contingencies should things change, that we have the flexibility of exiting. So I think the conversation needs to start early. Two, we can put your mind at ease by presenting you with alternatives that you can explore, and don't auto renew with your current lender. Explore and go to market and ensure you're shopping your range.
Yes, I find, and this goes back very many years when I used to work in the telecom industry, that Canadians are very loyal to brands. So let's say they have a cell phone with Rogers or Bell, they kind of stick to that. And then they'll go out and be like, hey, I need a new phone. And you almost have to talk them into getting a better rate and getting a better price. So I think that it's sort of the same thing where they've built loyalty with a certain brand. It's tough, but I think a lot of people should look at that. And the beauty of some working with somebody like yourself is that you can actually go in and not just have one choice. You have a bunch of choices where you can sort of play them against each other, right?
Absolutely. And we are definitely a brokerage that doesn't go away after renewal. We stay in touch with clients. A lot of the work that we've been doing over the last just, few months with rates coming down is looking at clients that locked into the higher rates and breaking those mortgages. This month alone, since November 1st, we've saved clients over 200,000 in interest through breaking mortgages. So
Crazy.
it's I know it's scary. It seems overwhelming. What documents are they going to need? But it's also the client onboarding process with one brokerage to another can vary. We make it very seamless. We make it pain-free. You could source a pay stub, maybe a T4. We'll make the process very, very easy. Oftentimes, we can even help you source the data. We want to be there as a concierge. Just literally default the task to us. Let us take that on for you and ensure that we're giving you advice. And sometimes that may mean staying with your lender, but at least you've done your check-in. At least you've ensured you've asked the right questions and you're making the decision that's best for you. And that's what we recommend.
Right. And personally, it would frustrate me a lot when it was like, why don't you want to pay less? And so, and now when I look at it, and me having mortgages myself and thinking about why I haven't moved from my bank, because I've been with TD forever. And so now I'm for the first time thinking about shopping rates and going around and looking at other rates where I see other rates that are much better than TD. I'm like, well, I'm a free agent. I can do what I like. And so I think it's important for us to really support this kind of competition, as people that have mortgages, not just kind of renew with the last person you had, but at least check your options and see what you can get so you can start to drive down these prices and sort of break through that habit of just renewing the second, you can just because it's convenient.
For sure, we all are creatures of habit. We become familiar and comfortable with our surroundings. But if you're able to default it to somebody else to manage for you, every extra dollar matters. And it's about taking that smart, proactive approach. And shopping your mortgage renewal, that's where it starts.
Have you seen a lot of people moving away from who they were with to
Yes,
somewhere else? You've seen that
yes,
because it's been
absolutely.
easier, I guess, right?
I find that on your renewal, a bank isn't going to offer you the lowest rate.
No.
You find that institutions don't necessarily value the loyalty as they used to. How
What
often
was
do
it?
we go into a bank? We don't know anybody. We're literally calling in. There's a disconnect. It doesn't feel like the connection isn't there any longer. It's so important, right, to ensure that you are shopping and there's that disconnect. The loyalty is based on the fact that we get comfortable, but it isn't necessarily reciprocated. When you're getting your auto renewal, it isn't the lowest market offer. Also, when rates are continuing to come down, do you really want to be signing today for a renewal that may happen mid-December when rates may come down? Whereas we can shop the rate right up until the renewal date. So ensure that you're also making a decision that's smart based on the current rate environment. We're going to be seeing rates come down. We don't know by how much on December 11th and then again on January 23rd. Ensure that you're able to capture any changes right up until that date.
So, in the grand scheme of things, do you see competition getting better, or do you see it sort of staying status quo, or do you see it getting worse in terms of what you've seen so far, trend wise,
With respect to mortgages,
with respect to mortgage rates and competitiveness of the lenders?
so we're definitely seeing rates, lenders be very competitive, extremely competitive. I definitely think there was a slowdown in market activity, and there is this mentality of really taking market share. But again, I've said this a few times, it's more than rate. And when I say that, it's because if you were a client that locked in 2022, 2023 with almost a 6% rate, and that was sort of, let's say a 5.99 rate was sort of standard across institutions, picking one over the other is so much more than rate. It's understanding, is there an exit? Is there the ability to break that mortgage with minimal penalties? How quickly does that lender reduce their posted rate as the Bank of Canada moves rates? So there's so much more to the conversation. And I think it's important to understand that most consumers don't know this information, don't know how to run these calculations, and they shouldn't, but defer to a trusted professional to do that for you. So much more than rate. Ensure that you're getting an education. Ensure what matters is not the interest rate that we're bragging about when we have a dinner conversation. The conversation is how much interest do we pay over the life of owning that property?
Right. And that's, I think, what a lot of people sort of miss. And they don't want to mess with something that's working, I guess. But I think it's totally worth it to get a second opinion on something that's, going to cost you so much money in that small period of time, right?
Absolutely.
Now, in terms of mortgage rates and where they're going to end up, and I know it's tough to sort of predict, and I have my own thoughts on where it's going to end up. But you being in the industry and knowing exactly sort of where the pulse of all this is, and I know you can't really like be bang on it. Where would you say is going to be like the bottom for this?
I think we'll probably see rates hover, at about 3.5% on the fixed rate side. I don't see rates coming down to those record lows.
Hmm.
And I think that reality check is important for home buyers or, just consumers as they're reassessing their situations. So I do think it's important that we're taking a realistic view of market opportunities and balancing it with the fact that rates may hover in the 3%, but I don't see them going down to what we saw in previous years.
So
That's
like
my
no
personal.
close to zero then.
I think those days are gone.
I think that's not healthy either. I think it's 3% is a good healthy amount. I think if
Stable market.
I'd be happy there, I'd be
It's a
happy.
stable
Yeah.
market.
So you have my blessing for 3%. So now, would you say? I know some of the government programs are kicking in soon. Would you say some people are waiting for them? Would you say more could be done? Could they be, tweaked here and there? Could there be something that could be a little bit better? In your opinion, that could help out, say, first-time home buyers, the people that are really trying to buy these houses, especially with new construction, because I see a lot of them just kind of sitting there waiting. See some of them picking up again, but a lot of them just waiting. Some of them going into, some trouble. But we obviously want to get this going, especially with first-time home buyers. What would you say? What would you say about that?
I think these changes are definitely offering first time homebuyers the flexibility. I really do. I think that if you're a smart consumer, you're not waiting till December 15th when everybody else is. You're looking at potentially maybe assessing your qualification going to market, but closing in the new year where we can get you requalified under the new changes. So there's opportunities in the market today. It's understanding that you get the education, you know what opportunities are available today. I do think we're going to see an uptake in market activity. So if you can get into the market today with a longer closing date, you can then take advantage of these new rule changes in the new year.
Awesome. Awesome. And I think that would be helpful for a lot of folks, especially as the rates go down. They get that on the other side. I think it would be great for everybody to start getting in, especially if they're not in already. And so looking at the one of the biggest sort of barriers to get into a mortgage or renewing your mortgage or doing all the paperwork, does your company make that any easier for folks?
We do. We do. I think I've been very mindful of our service level agreements, keeping clients informed. If a client has to message us on an update that we've dropped the ball, it's all about active communication, streamlining the process. Our application process takes no more than 5-10 minutes max. You're giving us some very basic information. It's a very personal process. You're connecting with me on a 15-minute Zoom so I can completely understand where you want to be. I often say it's like watching the final scene of a movie. I want you to share that with me so then I can construct the strategy to match that end goal in mind. So that's our process. We're very much about the client experience with over 400 five-star reviews. It's all about the client relationship. It's ensuring clients feel supported and active communication post closing. Your bank doesn't call you months after and say, how are you doing financially?
No, not once.
So you want to ensure that you're working on having a budget. You're ensuring that if life changes, that you're constructing and have a strategy on tweaking numbers, ensuring that you're aware if you want to buy a new home in 2 years. Most first time home buyers statistically are going to make a move or make a change to their mortgage in 2.25 to 3 years.
Right.
We're aware of that. So we're going to construct a product that prepares us to make those adjustments. When a client does call us, we can say, yes, we were anticipating this. We knew this was a goal. We built it into the contract, and now we're ready to support you.
Very good. Very good. So, one other thing I want to chat with you about is fees. So, in terms of, we know that we can get more money now with less down, but that also means that you have to pay that CMHC insurance.
Yes, you do.
Can you explain to us how that works for folks that don't know?
Absolutely. CMHC premium or the Genworth or Canada Guarantee Premium. So there's three insurers in Canada. The amount of the premium is actually calculated on a sliding scale, and it's going to be based on the percentage down payment that you're able to put in from your own resources. This amount, for example, if you're doing the minimal amount down, which is 5% of the first 500,000, 10% of anything above is going to be an overall 4% of the overall mortgage amount. This gets added to the mortgage, so you're not paying it out of pocket. It does get added to the mortgage and it's amortized over the life of the mortgage. So it's not an out of pocket expense, but it is a cost that you want to be aware of.
I'm just kind of curious if you've ever done the math on this. Does it end up being the same amount? Well, it's hard to do, I guess, unless you have like a fixed mortgage. At one point, does it make sense to pay over the 20% so you skip the CMHC fee? Or is it going to be very comparable where it doesn't matter?
So that is really opportunity cost. If you're going to have to wait and save for that 20%, and that may take you another year or two, you're going to be making that up in additional sort of having to buy something at a higher value because appreciation rates historically have been 4+%
Right.
in the Toronto and the GTA market, even in the outskirts. Given that we want to take a longer term focus with your purchase, we're going to advise speed of market. Speed to market is always the best solution because it's going to give you the ability to get into the market today, ensure that you're able to capitalize as prices go up in value and make up that difference versus waiting.
Good. That makes sense. That makes sense. Why wait when you can get it now and then you get more equity? You
Exactly.
can always put it down later if you got some extra money, right?
Yes, yes. The goal is to get into the market and work on a strategy for prepayments as well. It's not about paying your minimal payments, it's also ensuring that we're working on a strategy to help you aggressively pay that mortgage down. And we can do that through very simple tweaks as well.
Right. Have you ever heard of municipalities having different programs that they would offer for first-time home buyers or tenants that are wanting to become buyers again? You ever heard anything like that?
So there are some limited programs, but there's not a lot of availability. It is very, very specifically sort of focused on, for example, there's an Aboriginal program where you will be able to match a certain portion of down payment up to a certain percentage point. But based on municipalities specifically, that isn't an area that we specialize in or have seen much of.
Right. So generally, you see any kind of incentives coming from the federal government, not from.
Correct.
Very cool. Okay. So tell us about this. Tell us about this mortgage stress test. It's been around forever. And obviously, when you're renewing now, you don't worry about that as much anymore. But if you're getting a mortgage, what is the stress test?
So the stress test is a rate at which we need to approve you when we're looking to see how much we can give you as a mortgage. So what a lender wants to know, or the federal government wants to ensure, is that you can carry a mortgage at the stress test. So should rates go up, that you can still afford to carry your mortgage payment. Now, the stress test rate is going to be whatever mortgage rate that you have secured on your commitment plus 2%. So in today's rate environment, for simple math, let's assume that you have a 4% interest rate. We'd have to qualify you under stress test at 4 plus 2%, which is a 6% rate. So should rates increase up to 6%, you should be able to comfortably carry that mortgage. And that, in essence, is the stress.
You made that sound so easy. That was awesome. It's great. It's a, I thought it has a lot more complicated. That's pretty straightforward.
It's a really simple sort of standard that the government has put in. When we were seeing record low rates, that 2% mark, where we ran into trouble was when rates exceeded that 2% sort of variance. And we were seeing rates increase significantly higher beyond that. And that moved to clients feeling uncomfortable. So I think it's a really great safe strategy to have in place to ensure clients are feeling comfortable, safe, and secure with their payment.
Makes sense. So I'm calling you. I have a sorry. Let's do it like this. So I have a client that I'm going to refer to. They go out to you. What does this client need to have ready to go before they call you or before they have their sit down meeting with you?
So generally we'll connect right off the cuff because we want to ensure that we're also taking the stress away of organizing this documentation. It can seem overwhelming.
It is.
So I generally like to have the call first. You can come in completely unprepared.
Awesome.
But if you are, ensuring that you are prepared, it's a really simple process. If you're salaried, we want a pay stub. If you're hourly, we're going to want a pay stub. We're also going to want to see the previous year's T4 as well. T4. Sometimes we'll ask for the last 2 years of T4s. And if you can't locate it, I promise you your accountant will have a copy. So it can be sourced. Or you have an employee portal that you're going to need to log into to print off a pay stub, but it also gives you the ability to just print off your T4s. And that's generally where we're starting if you're hourly or a salaried employee. If you're self-employed, what we're going to want to see are your tax returns. And this can be sourced by, again, reaching out to your accountant and asking for the last 2 years' tax statements. And that gives us the ability to really look at how your income is being documented when you're filing your taxes.
And if you are self-employed and you're not an accountant, you should get an accountant.
You should, because you want to ensure that we are being smart about how we are declaring your income and that you're using write-offs that fall in your favor in terms of our ability. For example, when we're self-employed, I'm self-employed, Amir, you're self-employed. When we're filing our taxes, we want to reduce our tax exposure, and that can be done in a very smart way. And I think that when individuals are self-employed, there's this fear. I don't show all my income. I can't qualify for a mortgage. Well, we break the box on lending guidelines. I can get you approved at a bank if your tax returns are constructed correctly, because we can do stated income. We can present a business case to a bank, background on what you do for a living, how much gross revenue you source, and why your income at the time you're filing your taxes might be less than what you're actually earning. We can build a case for it. We can get you approved. So it's a very simple process of sourcing the needed documents. I do believe that individuals will often, because money and fear are so closely connected, will resist sort of the process of making these inquiries or asking these questions, but it's a really simple process to get this started.
Right. And generally, from the time that they see you, let's say they have all their documents ready, they're one of those really organized people and they just give them to you. So we have sort of a pre-approval. How long does that take?
Usually 24 to 48 hours. Now, a client does not leave my call though with some real information to walk away with.
Okay.
And the reason for that is whether it be a quick intake, I can usually ask questions that will give me the ability to give a client enough information at the call to see if it's worthwhile to start it now or should we wait. So we will always, within the first 10 or 15 minutes, be able to provide a client with enough value. I think it's important to add value. I don't want to be that mortgage broker that sends you a link or asks for everything under the sun. I think it's important to develop trust, ensure that you're walking away with immediate information that's going to help you take that first step, sharing details, your personal financial details, and ensuring that we're positioning you again for what's best for you. And that may vary from one person to the other. And we can get creative with down payment strategies as well, because that usually is the piece that's often holding people back. So having that conversation allows us to get creative.
Right. And coming from that service sort of mindset, I think is really amazing because a lot of folks that get into our business and do well, a lot of times forget about what it is that that brought them here to the success that they have is taking care of people, taking them from here to here, and instead of sending them that link where they go and fit in all the information, you're actually taking them step by step through, which is generally, whether you've done this before or not, always a nerve-wracking process. So
It's so important to
yeah,
understand. I had a young family, they had a young baby, and that daycare payment was the equivalent of a good portion of their mortgage payment. So I think it's so important to ask questions that may not necessarily appear on a credit bureau.
100%, 100%. That makes sense. Well, I think on that note, we're all set here. Rakhee, it was so awesome chatting with you. You're full of amazing information. I hope we can chat again soon once we have some more changes happen and give folks an update on what's happening out there. But it was really a pleasure sitting here today and chatting with you. For folks that want to reach out to Rakhee, we're gonna have our information down below, or up, or down, or on the sides. We're gonna have it somewhere, and just click, and they'll take you right over to her website, and you'll be able to follow her and connect with her from there.
Sounds good. Thank you very, very much for the opportunity. It was lovely chatting with you today.
Thank you.